Commentators have been quick to talk down Wall Street's rally, pinning it on little more than the so-called Magnificent Seven. But should we be so quick to dismiss the strong first half of 2023? Paul Ashworth from Cameron Harrison joins me to chat investment strategy. Paul, we have heard this probably for a good 3 months now, that really this is a narrow rally. It's one that's been driven by perhaps AI hype and just simply multiple expansion. But I guess from the note that I've read that you've produced recently, you say, well, it's not that simple. Can you explain?
I think the key point here, Kyle, is, of course, what are we comparing to? And if we spend all of our time comparing ourselves to the S&P 500, by definition, we're going to be forced to look at those Magnificent Seven. We're going to be looking at the Apples, the Alphabets, the Microsofts, the Nvidias, the Teslas. And that is by definition because they are the largest market cap stocks and they are going to dominate the index. I think the key point that we want to make is that the US economy is 4 to 5 sub-economies, and those sub-economies are huge. And there are businesses there, there are they're best home builders. They're the size of Coles Myer here in Australia. A business like Pulte Group. Vastly exceeded any of those Magnificent Sevens. There's a whole number of those very significant businesses. Yes, they're medium-sized businesses in the US, but they're very large businesses, in an Australian investor's context. And I think the risk is, the danger is always in the assumptions. If we simply say that here's 7 stocks that have produced 80% of the return of the S&P 500, I think the real risk is that investors are failing to see that there are some very significant businesses out there outside of that index weighting. And maybe people need to have a little bit more of a closer look, particularly in terms of the US market and the role of index weighting. One as to composition and obviously 2 as to benchmarking.
Actually, that's the next point I want to bring up. Just to start with, was that kind of benchmarking situation, because I guess in the way perhaps to play almost devil's advocate, it's the argument for just buying the index and investing passively. And a lot of economists would tell you about an efficient market and that you shouldn't try and beat it. Just we'll go with the flow, if you will. But is this kind of almost an issue, and I'm sure there's a better word to describe it, but effectively a shortcoming with benchmarking here, that again, if we do have these very narrow set of stocks that you're comparing yourself to, well, one, you're actually taking on more risk because you're exposed just to those 7 names, but it's going to be very difficult to reach your investment outcomes or your investment goals, because you constantly be chasing, again, this kind of very illusory, or elusive, I should say, kind of target, if you will.
Carl, I think that's an excellent summary. The role of indexes in terms of their composition, that predates, if you like, what we see now in terms of the role of indexes as products, through managed funds and through ETFs. That's not why they were established. From a construction and from a risk management perspective, and you've said it there in terms of the risk factors that go clearly with concentration risk, but also what we can see at the moment, which is size premium risk, which we think is pretty significant. We would invite people to think in terms of if you like, a dispassionate approach to construction, and that is to look at quality businesses in terms of their composition. To simply take the index, and simply buy that outright without putting some even some basic quality filters to it. We know that outperforms. but secondly, it outperforms when you actually operate it on an equally weighted basis, particularly when it comes to drawdown risk. And I think that is, pretty important at the moment. We're talking about market valuations. We're talking about some of that size premium in terms of that magnificent seven, and an equally weighted portfolio construction, which is the way we've conducted ourselves now for over 30 years. Shown to be vastly better in terms of risk-adjusted return. So I think you're right. Simply just accepting the index for index sake. Is there other means for simple and effective portfolio construction?
Of course, every financial planner will tell you, and there's always that kind of caveat on any kind of investment strategy, or if one were to give advice, which of course we aren't here, is that it's kind of a horses for courses situation. Not one size will fit all. But I mean, when you're talking about what you're just suggesting there with an equal weight portfolio, or even say somewhat, if I'm not mistaken, maybe a market neutral portfolio. One, I mean, do you think that now is a better time to be taking such an approach because we are getting these divergences in asset price performance? And two, I mean, is one of the virtues of that strategy that it, maybe over the long term you see, the same returns as just a benchmark, but what it irons out some of that volatility so you don't experience some of those rough drawdowns, inevitably when they do occur?
Yeah. So take your first part of your question in terms of market timing, which is a fraught exercise there, Carl. But yes, the empirical data, over 120 years of index performance, would show that equal weighting is certainly better. Where you expect that drawdown risk might be more significant. So the answer to that, would be yes. But it's equal weighting with reference to some primary quality factors. And that research, the original research in terms of the size premium and the smaller companies over the long run outperform longer companies. I think that's been reasonably debunked. But the further analysis as to quality companies, in terms of that size premium, that's pretty strong, and I think that's fairly unequivocal in terms of the empirical data, and that does make it simpler for investors, and it makes it simpler, for the risks that we're talking about at the moment in terms of valuation. There are very good businesses, out there, globally, as I said. They're leaders in their regions. Let's say in terms of the US. In Australia, there'll be some of the largest businesses on the ASX. So it's just really to take the blinkers off, to look at those assumptions and say, but really, what is the S&P 500 actually useful for? And as you said, we're not here to give advice, but actually, how does it actually relate to what I'm trying to achieve, which is to invest offshore to get comparative advantage to things that I can't invest in here, and quality of businesses that I can't invest in my own jurisdiction.